Welcome back to Everything Money. We're so happy you joined us again. As always, I'm Seth. I'm here with Paul and Mo. We're going to talk about Microsoft today. We welcome all of our viewers in from all over the world and those wonderful patrons. If you're new to our Patreon, we welcome you in. We're happy you joined us. Microsoft, obviously, Paul, is an incredible company. You get fired up. Just the word Microsoft fires you up, Paul. You literally,
I love it.
You shout out expletives just hearing about this company. Why do you love Microsoft so much?
I've always thought they were a great company. They were my first ever true value play. When I started to do, I did ETFs for a long time. And then the early 2010s, I started buying individual stocks. Sorry, in 2009, I started buying individual stocks when the market crashed. And I remember in 11 and 12, I was just captivated with Microsoft because I was looking at their financials going, man, I just keep hearing how they're a dead company. But I remember off the top of my head, their revenue growth was 8% a year consistently. It wasn't like it was like this. It was just like this. And their profit growth was 11% per year. And they were selling for 9 times earnings. And I was like, how can they be dead? And everybody out there was telling me, Paul, that every tech person, Microsoft's dead. They're going to be surpassed by everybody. This is a dying company. I'm like, but their revenue is going up. I even had some people argue with me that their revenue was not going up. And I was like, but I'm just looking at the financial statement.
Yeah.
So Microsoft has now redeemed itself. They got into cloud-based computing. They got into other things. And all of a sudden now they're not dead and they're selling for 35 times earnings. So 4 times more. So that's why I get excited about it. Plus, Bill Gates was my original idol of idols when I was a kid. And I remember he was supposed to come to the Akron Investors Hall of Fame. Do you know we have the Investors Hall of Fame here?
I've seen it. Haven't gone yet.
I haven't gone either. And my dad was going to get me tickets to go. And I remember thinking to myself, I was in Mr. Rohr's, what was that called? Western Civ class.
Yeah.
I remember thinking to myself, I think I'm going to cry when I see him.
Oh my gosh.
And then he canceled.
Oh, darn.
And then Bill Gates canceled.
If you're new to watching the channel, I bring your sort of normal person questions to a couple of wealthier dudes. And if you're looking to move out of ETFs, maybe gain control of your finances and your savings, your investing, you can follow along with our website, our software, and Paul. So this is a big step, I know, moving from ETFs to actually buying individual companies.
By the way, even if you don't want to move to individual stocks, just getting an understanding of how to think about investing, because this mindset will still help you when you're investing in ETFs. It'll still help you look at sectors. It'll help you when the market falls and you're afraid and everybody's afraid. They say the world's going to end. And then all of a sudden you wake up and you're like, the world's not going to end. That's another reason to listen.
Yeah, so if you've only ever thought about stocks as a ticker price, we're going to show you the fundamentals behind the company, the money they make, the shares they have, and see if that stock price is justified. We'll head over to Trader Mo. He'll look at the charts, the ups and downs, and if you want to buy on a more of a shorter trade. But for right now, Paul, let's use our 8-pillar wonderful analysis and our software behind you to look at Microsoft. What is the market cap of this gigantic company?
$2.15 trillion. So PE is 35, which is an X, but a very healthy gross profit margin of 36% and a gross margin of almost 70%. It's software. Once you create the software, that's the expensive part. All right, we have a dividend yield of 0.8%.
Adorable.
Now remember, guys, if you're new to the channel, dividends are not always secure. You have to compare the dividends. A lot of people talk about the payout ratio versus earnings. I look at the free cash flow because you use free cash flow to pay out dividends, buy back shares, make acquisitions, pay down debt. And they paid $16 billion in dividends versus their $54 billion in free cash flow last year. So they're pretty safe here. Look at this, Seth. 20% return on assets, 15% return on invested capital. I mean, these guys do a good job of reinvesting the capital in the business through debt and equity. They do a phenomenal job of it. So they're right now just 1X and 1 check.
Yep. Okay, pillar number 3 is revenue growth over the past 5 years.
Let's look at how dying this company was.
Yes.
You ready?
Yep.
96 billion to 168 billion. And this is back here when I said it was not dying. So anyhow, so that's definitely a check mark for revenue growth. And this is one of the consistent revenue growth companies out there.
How's profit growth? Pillar number 4, Paul.
Equally impressive. 25 billion to 61 billion. Check mark there.
Yep. Okay. Shares outstanding. What is a big company doing with their shares? Are they selling more or are they buying them back?
They're buying them back, but not by much. 7.7 billion down to 7.5. Now, my guess on Microsoft will be, as it gets larger and larger and can't reinvest its capital, they will be buying back a lot of shares. I don't know when this is going to happen, but this tends to happen in bigger companies, especially as eventually when the growth starts to slow and people start to punish the stock, they're going to want to buy back shares to increase the per share price, the per share revenue and profit numbers to boost up the share price. This is a very common thing done with inexpensive companies, okay? I'm hoping this happens at some point in the future. We're not going to assume that in our analysis, but these are the things that occur.
If these numbers resonate with you, looking at the numbers behind a company, you can have this software if you join our Patreon. And when we move off Patreon to everythingmoney.com, you can have access to the software by joining our Patreon. Paul, tell them about this software and what they get for it.
Guys, right now it's 80 cents a day, $25 a month. At some point it's going to be $49, but if you sign up, actually it's $26 a month right now. If you sign up today, it's 80 cents a day. You'll be at this level even when we go to 49. You get the mobile app, 8 pillars, 30 years or more of financial data, stock analyzer tool, daily content exclusive to just people who belong to the software and the app, access to us three, real estate calculator, stock screeners, retirement calculator, and the big mamma jamma, 4,500 people in our Discord community talking about investing. Our competitors are $200 a month, $200 a month, and $35 a month, and you don't get anywhere close to it. No brainer, 80 cents a day, sign up.
If you're serious about finally taking control of your investments, I don't know how you can move forward without this data. We're basically selling you data in our stock analyzer tool, and it's incredible. The Patreons love it. Paul, let's keep going. We're at current assets over current liabilities, which is pillar number 6.
So cash equivalents, $165 billion. $72 billion in current liabilities, and they almost have enough cash to pay off all their liabilities. My guess is, like other companies, interest rates are so low, they probably issued a lot of debt just to have it readily available, just to take advantage of low interest rates, et cetera.
The big mamma jamma is free cash flow growth, Paul. I'm assuming it's incredible. Wouldn't you think?
Probably. So 28 billion to 54 billion. Check mark there, almost doubling.
Jeez.
With an average of 39 billion. 39 times 20 equals 780 billion. So guys,
yikes.
What this means is we're taking 20 as a starting point. This isn't set in stone. For those of you who are our patrons and watch this, you know what I'm trying to say here. We just start at 20 times free cash flow because as it grows, you don't want to diminish the value of the most recent years that are higher. So I do a higher multiple than a usual 15. It's not to say this is set in stone. It all depends on growth rates, the company, what kind of industry they're in, how big they are, how small they are. It's a starting point. The company is worth 2.5 trillion market cap, and according to this, 20 times is 780 billion. Does that in and of itself mean it's over expensive? No. If they have really, really high growth rates that can justify it, we're okay with that. But Microsoft's already a very, very large company. I don't know what their growth rates are going to be, but once Mo is done with this chart, we're going to put this data in the stock analyzer tool, and it's going to tell you what you should be paying for the company, factoring in all the growth rates.
If you're interested in trading Microsoft, whether it's on a day trade, swing trade, momentum, multiple week trade, Mo will help you in that bid-ask nation. Mo, what's going on over here? They're overbought. Let's see.
We're overbought, but Microsoft is one of those companies where it's kind of okay because let's just look at look at that trajectory. It just, you do have your ebbs and flows, but overall they stay in the sweet spot for a very long time and continue to climb. So right now, of course, they're hitting all-time highs. You are in that overbought area, like Seth said, but this is technically a power stock. So a power stock is a stock that is over all 4 of its major moving averages, making new all-time highs, and that's what they're doing right now. So if they break out over that level to make new all-time highs sometime this week or next, you can absolutely go ahead and keep adding to this. The great thing is that you're over all 4 of those major moving averages. And you are clear of the 100 and the 200, which are very important. The most important thing is just keep focused on that volume. They're Microsoft. They always have a lot of volume. So if you ever do see Microsoft dipping below, you can see that they're always right at that average volume. That's that yellow line. If they're ever below there for a consistent amount of time, that's when you're going to want to stay away from them. But for the most part, you can definitely trade Microsoft a lot.
If this chart stuff looks like gibberish to you, you need to learn a little bit. About a month later, if you stick with this, you join the Bid-ask Nation, you can be trading with Mo, join our Employee Trader Series. He guides you through these trades, and people are making a lot of cheddar off of it. And I love the rules, Mo.
Yeah.
And when I get out of this photography more, I'm going to be doing more of this with you.
Oh, that's a great idea.
We had a guy.
Yeah, I'm drawn to this, Paul.
Are you really? Do you really like it? Is he doing well with it?
Yeah,
he's
good.
I'm understanding.
He's understanding it. We can have a conversation about it.
Yeah,
well, that's a good idea. I didn't even think about that. Like as you grow your nest egg.
You see,
we have a guy who joined the Bid-ask Nation last month, and he's already paid for 3 years of his Patreon fees. And how much was that? $69 a month.
Crazy.
That's
well, it's 76 now, but either way.
But he paid 69.
Behind Paul is our stock analyzer tool. This is the next step, folks, in finding out, okay, I kind of like this company. What should I be paying for this ticker price, which is somewhat hard to determine, Paul. So we've taken your beautiful Excel spreadsheet we showed years ago and turned it into this software, which is also part of our Patreon. Show us to it. What am I saying? Go ahead.
when I put data in, Mo will always send me a stock, say, Paul, I put it in stock analyzer tool. He sends a screenshot, and I think he's a little too liberal with his revenue growth numbers. I like to be very conservative. The reason being, this is for me as a value investor. I have options. I have businesses upstairs. I have real estate. I have options. I want to be picky on how I invest. Now, I look at the history. It gives you the 1, 5, and 10-year numbers, revenue growth. 17.5, 14.9, 9.6. It's actually gotten better. But I don't believe that Microsoft will, the next 7 years, I do a 7-year analysis here. I don't believe the next 7 years will be as good as the last 7. Could I be wrong? Absolutely. But my goal is to buy a company that's obviously selling at a discount. So I put in 6, 9, and 12% revenue growth. Share buybacks, you have to put in, I did assume share buybacks. Profit margin, I put in 25, 28, 31. Free cash flow as a percentage of revenue, 28, 30, 32. PE, the larger and larger a company gets, the harder it is to grow. You can justify a higher PE with a higher growth rate.
You said this in another video. You said, what's easier, to go from 100 million to 200 or 2 billion to 3 billion?
100 billion to 200 billion, 165 billion to 330.
Yeah.
It's much harder to do that. So you have to assume a slower growth rate. Now, recently, Microsoft and Apple have proven us wrong. They can still grow at high rates of return, at high levels. But again, my job is to be very conservative. Then I also put desired annual return. In this situation, you go from higher to lower, because the higher your desired return, the less you pay, right? If you pay more, then you make less money. So in order to get a high return, you have to pay less for the company. I hit the analyze button.
Paul, before you go there, their profit margin already is 36.5. Why?
The last year.
Go on.
So the last year, and this is part of being conservative, their profit margin has ranged between 26 and 36. Do I think I'm being overly conservative at 25? Yes, I do. And we will change these. Once we do this, I'll put another one in there and say, let's be a little more reasonable compared to history,
and
right?
When you have this software yourself, you can make all these different assumptions, change anything you want, come up with different prices.
Correct.
So.
But I encourage people, don't put numbers in that justifies the price. Put the numbers in, you sit there and say, okay, wait a second, what do I really expect to happen? Okay, so I hit the analyze button, and it's basically telling me Microsoft's way too overpriced. And you might sit there and say, Paul, how is it 70 to 220? That's a ridiculous range. It is a ridiculous range. Some people in this video are going to say there's no way it sells for 70. Guys, remember, Microsoft just 10 years ago was selling for 9 times earnings. If you apply that same multiple to here, it's selling for exactly $70 a share because it was out of favor. That's it. Now, let's go up here and assume different assumptions here. Let's assume they grow at 8, 11, and 14%. Profit margin, I'm going to go to 30, 33, and 30. I'm going to assume they keep their profit margin the same. I'm going to go basically the same thing here. But it's just to show you guys. And I'm just going to put, I still think my PE of 12, 15, and 18 is reasonable. Now, maybe my return, I'll go down in return because it's a bigger company with a bigger moat. It's harder to kill Microsoft, right? It's going to be much harder. Analyze button. So guys, basically what I'm doing here is showing it's just too expensive.
At the moment.
At the moment, it's too expensive. My best case scenario is a 275 price today, and that's assuming a lot of assumptions that maybe are hard to do. Maybe it will be easy to do. I don't know. But I look at the company going, it's probably worth somewhere in the low 100s, which is way better than before, but for a reasonable rate of return to also account for what you're going to miss. You know, investing is not knowing that you don't know the future. So the part of investing that's the art of it is determining, okay, what's the future look like? I like to look at the past. Ben Graham likes to look at the past and say, what does the past show that we can learn for the future? Howard Marks, same thing. You're reading the Richer Wiser, Happier book. Yeah. That's the whole point of investing. The whole point of this is to say, guys, I changed my assumption to the high side, and I still, on my highest assumptions, didn't get the price it's at today. So I just think that Microsoft's just an overpriced company.
March of 2020 was at 132.50. So,
was it really?
Yeah, so we can get there.
So anyways, love Microsoft. It's on my watch list. I will be there to buy it when it drops in price. The good news is if it goes to 130 or 120, the dividend will also be almost 2%.
Yeah.
So not only will you get a better company at a great price, you also get a much higher dividend than it is today.
I challenge you at home, if you're watching other YouTubers just always saying buy, buy, buy. Our channel is more focused on what should we avoid? What high flyers are in the news? They're being hyped up. I've changed my mindset, Paul, after reading this book about some of the most famous investors.
I love the book.
It's more centered around what am I avoiding today? You know, really careful decision I'm going to make. So Microsoft, great company, not a great stock price. We'll wait till it comes into our sweet spot before buying, as Mo would always say. So fondle the thumbs up on the way out. We'll see you on the Patreon, Discord, and we love you guys. Thanks so much for watching.